Across major industries today, the baseline sticker prices for commercial equipment continue to remain prohibitively high for most buyers. But a recent tax reform law known as the One Big Beautiful Bill Act, or OBBA, created a massive legislative loophole for businesses buying new hardware in 2026. This chart shows exactly how 100% bonus depreciation works. It allows a business to take an asset like a $100,000 machine and deduct the entire purchase price from their taxable income in year one, subtracting a $35,000 deduction block for a company in a 35% tax bracket to reveal a much lower effective net cost. This bonus depreciation stacks directly on top of the expanded Section 179 deduction limit. Section 179 is an IRS tax code that limits how much businesses can write off annually, and its cap is now expanded to $2.56 million, which covers almost all capital expenditures for small to mid-size operations. This creates a unique paradox. By financing the equipment, a business pays only a small fraction of the cost up front through monthly payments, but still claims the entire year one tax deduction. This preserves vital operational cash flow while maximizing tax relief. The primary trade-off to this strategy is that you have to commit to multi-year debt. Right now, average market rates for commercial equipment sit between 6.5% and 7.5%. Navigating this tightening credit market presents a serious dilemma. Applying to the wrong lender and getting rejected wastes time and damages your credit profile. In 2026, the biggest hurdle for a business owner is no longer deciding whether to finance an asset. It is identifying exactly where to source that capital without triggering a rejection. This is where BusinessLoan.Directory operates as a strategic filter for an unpredictable credit market. The platform takes your specific business profile and matches it against 75 different lending options simultaneously. This establishes your exact eligibility before you sign any paperwork or commit to a single lender. Utilizing an aggregator like this is an objective way to avoid blind applications. You protect your credit score and accelerate your acquisition timeline by knowing exactly who will say yes. Traditional banks act as the gatekeepers to the lowest commercial capital rates available, typically offering between 4% and 4.5%. To access these rates, banks demand strict input requirements. You need a minimum of 2 years of pristine tax returns and a FICO score of 680 or higher. A FICO score is a standardized metric used by lenders to evaluate an individual's personal credit risk. Once you submit those documents, the underwriting timeline stretches out. Traditional banks require weeks of manual processing to verify your financials. This manual scrutiny leads to high rejection rates. Newer businesses, or those with even minor cash flow inconsistencies, are routinely denied. This profile naturally fits highly established operations, like veteran medical practices or long-standing manufacturing firms with highly predictable revenue. Urgent logistics operations looking to add trucks or newly established restaurants are systematically locked out of this specific tier. Traditional banking products trade all speed and accessibility in exchange for the absolute lowest long-term cost of capital. For projects too large for a standard bank loan, the SBA 504 program serves as the heavyweight option built specifically for massive long-term capital expenditures. This chart shows the complex three-party partnership required to structure the loan. It divides the total cost between a traditional bank providing 50%, a certified development company or CDC providing 40%, and the borrower providing 10%. A CDC is a nonprofit corporation set up specifically to support economic development within its local community. To initiate this structure, the borrower is required to provide that 10% down payment upfront in cash. The primary outcome for the borrower is securing below-market fixed rates that are locked in for long repayment terms of 10 to 25 years. The major operational trade-off here is a grueling application and underwriting process that takes anywhere from 30 to 90 days to complete. Because of this administrative timeline, the SBA 504 is completely useless if you need to execute an urgent or emergency equipment replacement. Instead, the ideal use cases for this loan are acquiring heavy construction fleets or purchasing large manufacturing assembly lines, where planning happens months in advance. The SBA 504 is a strategic, long-term play that requires significant administrative endurance, rewarding that patience with unparalleled market stability. Fintech and online alternative lenders operate as the modern counterbalance to slow traditional underwriting. These lenders require minimal documentation inputs. They often accept businesses with just 6 months of operational history and approve FICO scores as low as 600. The primary operational outcome of this leniency is speed. They deliver digital pre-qualifications and liquid funding into your account within 24 to 48 hours. But you pay a financial trade-off for this speed. These loans carry steep rate premiums that often jump to 9.0% or 10.0% and beyond. This premium is justified in specific scenarios, such as replacing a blown commercial oven during peak season, or rapidly scaling a logistics fleet to meet immediate contract demand. Fintech and alternative lenders force businesses to trade long-term profit margins in order to guarantee immediate operational continuity. While 100% bonus depreciation makes 2026 an optimal year to finance, your return on investment only remains positive if your chosen debt structure matches your operational reality. This table evaluates a decision framework for comparing traditional banks, SBA 504 loans, and fintech based on asset lifespan and urgency. If you have low urgency but a high capital requirement, your scenario maps directly to the SBA 504 and traditional bank columns. Multi-year projects like heavy construction and major manufacturing inherently fit this slow-moving profile because the assets outlive the long underwriting process. Conversely, if you face high urgency and rapid equipment depreciation, your scenario maps directly to fintech and online lenders. Emergency hardware replacements in restaurants or fast-scaling logistics fleets simply cannot survive traditional bank wait times. Choosing the wrong column in this matrix can entirely negate the year-one tax benefits provided by the OBBA by trapping you in bad debt or stalling your operations. Equipment ROI is determined by the capability of the asset acquired, but it is executed by the strategic alignment of the financing channel. Do not apply blindly to lenders. Each rejection generates a hard credit pull, which actively reduces your future borrowing power across all channels. You can use the BusinessLoan.Directory marketplace as your essential final filter to completely eliminate this risk. Check what you qualify for at BusinessLoan.Directory. It takes under 2 minutes and won't affect your credit score.